Welcome to The Explainer. You know, if you're just starting to think about investing, you pretty much immediately run into this big question. Today, we're going to tackle it head-on: ETFs versus individual stocks.
Welcome to Wealth Forge AI.
So let's dive right in. ETFs versus stocks. Which one is actually the right place for your hard-earned money? It's a huge question, right? Do you play it safe and spread your money out? Or do you try to hit a home run by picking a few potential winners? Let's figure this out. Okay, so first things first, we need to get to know the two main players in this debate. Because really, they're not just investments, they're two completely different ways of thinking about how to grow your money.
Here's a super simple way to think about it. An ETF, that's like betting on the entire team to win the whole season. You're counting on the group's overall performance. An individual stock, well, that's like betting on your one superstar player to score all the points and win the game single-handedly.
So what in the world is an ETF? It stands for Exchange Traded Fund. And honestly, the grocery basket analogy is perfect. Imagine buying one basket, and inside you get a little piece of hundreds, sometimes thousands of different companies. In one click, you're diversified. It's just a way of saying you haven't put all your eggs in one basket. Now, an individual stock is way more straightforward. It's exactly what it sounds like. You're buying a tiny piece of ownership in one single company. So if you buy a share of, say, Tesla, your investment's success is completely tied to how well Tesla does. All your eggs are definitely in that one basket. All right, so that's the theory. But let's talk about what really matters, right? The results. When you look back at history, which of these strategies has actually won out? Well, you know, the historical data is pretty darn clear. If you look at broad market ETFs, like one that just copies the entire S&P 500, they've consistently given back somewhere between 10 and 12% a year, on average, for decades. It's not flashy, but man, it is reliable. But I know what you're thinking. Wait a minute, what about my cousin who bought Amazon stock in 1999 and is now retired? Yeah, those massive, life-changing wins are absolutely possible with individual stocks. But how does the average person do when they try to pick and choose stocks? What does the research say? You might want to sit down for this one. Study after study shows the same staggering number. About 90% of active investors, we're talking people who are actively trying to beat the market by picking stocks, fail to do so over the long run. 90%. So why? Why is it so hard? Well, the number one enemy is usually our own brain. It's so hard not to get swept up in the hype and buy at the very top, or to panic and sell everything when the market takes a dip. We end up buying high and selling low, the exact opposite of what you're supposed to do. It's not that it's impossible, it's just that our emotions get in the way. Okay, so let's put these two head to head, a direct, no-nonsense comparison of the good, the bad, and the ugly for each strategy. And here it is, the fundamental trade-off. With ETFs, the pros are huge. You're diversified instantly, the fees are usually super low, and honestly, it's way less stressful. The downside? You're just gonna get the market average, no massive home runs. With stocks, the pro is that chance for those rocket ship returns. But the cons? Whew, they're big. It's high risk, it takes a ton of research, and like we just saw, most people end up just not doing as well as the average. Hey, by the way, just a quick pause. If you're getting some real value out of this breakdown, do me a quick favor and hit that subscribe button. We put out simple explainers just like this one every single week, and we'd love for you to join us.
So where does that leave us? What's the final answer? Well, here's the most important part of this whole thing. Maybe you don't actually have to choose just one.
See, a lot of experts suggest something called a hybrid approach, and the idea is actually pretty genius. First, you build a solid, safe foundation for your portfolio using those low-cost ETFs. Then, with a smaller chunk of your money, you can take some shots on individual companies that you've researched and you really believe in for the long haul. So, what does that actually look like? Well, your portfolio might look something like this. You've got a big, stable core, maybe 80% in those ETFs, just chugging along, capturing the market's growth. And then you have that other 20%, which is kind of like your fun money for those potentially high-growth stocks. And this is why it works so well. You're basically locking in those steady market returns as your foundation, which massively lowers your overall risk. But you still give yourself the chance to hit a home run if one of your stock picks really takes off. It's the perfect balance of long-term stability and exciting growth potential. You know, you can think of it like this. You're building a really solid house that will stand for decades, but you're also buying a few lottery tickets on the side. It's a strategy that helps you sleep at night while still letting you have a shot at something amazing.
But at the end of the day, the right choice really comes down to you. So we want to leave you with one final question to think about. Is your portfolio built for the long game, for tomorrow, or is it just chasing a quick win today? And that's our look at ETFs versus stocks. If this explainer helped clear things up for you, please give it a thumbs up, maybe share it with a friend who's also figuring this out, and drop a comment below. We'd love to hear